First of all, thanks everybody for making yourself available to this call. The reason we've put it together is clearly it's different times and uncertain times on the ASX, and we thought it would be a great opportunity for you as viewers, an opportunity to bring together various minds throughout the capital markets and various participants to give their views and give you the opportunity to ask them questions regarding the ASX and how to invest and some of the metrics and measures that they are using to make investment decisions. I should preface this call with the fact that clearly the information and the answers that each of the presenters are going to give shouldn't be classified as financial advice. This is very much information that they're sharing, and if you wish to move forward with any of the information that you receive today, you should do so after following your own research and talking to, if appropriate, your own financial advisor. So what I thought I'd do to give everyone who's watching a bit of an overview and background on who the presenters are and the panelists is do a quick run around so they can get an understanding of who they are. So maybe if I start with you, Niv, just a quick couple of minutes on yourself and Peak's business.
Yeah, hi all. Niv Dagan from Executive Director of Peak Asset Management. We're a small boutique corporate advisory business based out of Melbourne. Our whole model is based on the co-invest model, which means that we don't put opportunities in front of Adam or Ben or John or David unless we're backing them with their own capital. We have a corporate advisory arm. Everything that we do is sector agnostic, so we do look at anything from mining all the way to infrastructure, technology, blockchain enterprise, candy subscription businesses. Very particular in what we do, and yeah, thanks very much for having us.
Great, thanks Niv. And Adam, over to you.
Yeah, so I'm with Canaccord. Canaccord's obviously a global firm, but the stuff I've been around for a long time, the broking industry through various cycles. Our specialty is probably more trying to pick particular opportunities that occur maybe in the blue chips, or if we're not dealing in more the top 20, sort of something in the more emerging companies end. But if we find something we like, we'll take a good position and we'll sort of stick with them for a number of years.
John?
Thanks, David. Welcome, everyone. Pretty similar to Adam. I'm with a company called Hartley's, based here in Western Australia. My background's actually offshore, so I specialise in international clients for Australian stockbroking. So about 50% of my clients are onshore, 50% are offshore. And I've noticed in the last little while, we get onto this later, that quite a lot of interest in Australia with a low dollar and the market having, a 30% pullback. So typically we put together investment portfolios for clients, diversified. Our house, Hartley's, specialises in junior resources and energy. So we have that end covered as well. But that's it from me, thanks.
And Ben, finally to you.
Thanks, David. So Ben Williamson from Fresh Equities, a bit of a different play in the market for those that don't know us. We help investors who want access to capital raises but just don't happen to have the right broker relationship at the right time. So last year we worked on just over 400 placements and shortfalls. This year so far it's about 85, and working with Hartley's, Canaccord, Peak, about 50 different lead advisors in the market. So just pulling those together. We've only been around about 18 months, but growing quite quickly. I think we're up about 400% year on year. And I think, as we'll touch on a bit later, there's a lot of raises coming through the market.
Great. So what's up 400%?
Our throughput's up 400%. Definitely not the market. Yeah.
well done. Well done.
Yeah. Thanks for that intro, everyone. And I would just remind people there is a function to ask new questions of the presenters. So as we go, we'd very much welcome you, the attendees, asking questions of the presenters. All you need to do is write in the Q&A button down the bottom there, and you'll be able to ask the questions, and we'll get them put to the presenters. So maybe if I kick off, we're clearly in an uncertain time, uncertain market. Adam, do you have a go-to strategy when it comes to investing during uncertain times?
Well, yeah, not really, but you're just looking for good companies with good management. every time you get, and I don't want to be flippant about this, but every time you get a various cycle, everyone says this cycle's different, this cycle's different. What you do find in every cycle is there's some good companies that are well positioned, good management, long history, have now just been whacked with valuations because everyone's scared and fearful. So the only go-to strategy for us is just, we probably know what those companies already are, and then we're just taking a view, we can now accumulate them at a cheaper price. And then the other go-to strategy is when you've got, well, we only try to go in the emerging companies with good management, good product, they're generally well cashed up, but we're always looking for those opportunities where someone, so it doesn't really overly change, it's just the opportunities come far greater. So now you've got a bigger basket to select from, so you take your time and go, oh, I'll pick that one because you just can't do all of it. So, and I guess we just take a view, fast forward 3 or 4 years' time, this would have all passed. So we don't get too overly caught in the moment, except for trying to work out what opportunities it throws up to us.
So John, is that similar for a Hartley's?
Yeah, look, I agree entirely with what Adam said, and Adam made the point he's been around for a while, and we've seen a few ups and downs, and the temptation is in these markets, oh, this time it's different. It's never different. It always goes down, and eventually it comes out. I think in this case, a lot of pundits were expecting a pullback at some stage, and I still don't think the market was trading at an idiot premium. I mean, I don't think it was champagne and cigars. It was a modest premium to its long-term price to earnings ratio. And secondly, that can be also justified by the, if you like, the difference between the sort of returns we get from the yield in the Australian market versus fixed interest. So, you know, it was like a comfortable dinner party and enjoyable dinner party, but it wasn't a wild Gatsby-esque party that, you know, we deserve to have this happen. So I don't think any of us expected the coronavirus, and that's what we've got, and that's what we're dealing with. And in many ways, our response to what crystal ball gazing, what's going to happen, is all about COVID-19, and it's very difficult to work that one through. But I agree entirely with what Adam was saying earlier, that we will like come out of this as we come out of everything else, and it's a case of look through across the valley. We may have seen the bottom, we may retest our low, we may breach our low, but I agree entirely with Adam about looking at companies with good management, great market position that have been sold off. Now, I think we saw that to an extent with CSL, which is arguably Australia's greatest stock market company, a fabulous success story for all of us who've held it for a long time. And that went from sort of 360, 370, did the dive with everyone else down into the early 200s, went back into the 300s, back to the 200s, and now seems to be, you know, it's debatable. We'll only find out in a few weeks whether we do retest those lows. So that's a great opportunity to add a terrific company like that to our portfolio. And looking at it in a couple of years' time, and, you know, we bought it on that dip, or we added to it on that dip. But the only other point I'd raise in terms of your question, how do we deal with this? You know, rule one is if you're going to panic early. It's no point panicking, you know, down the bottom and liquidating things. Most of our clients don't do that, but they're quite entitled to ask the question. If it's a good portfolio, keep it and look at the horizon. If it needs a bit of fixing up, you can always sell cheap, buy cheap. You can sell something that's underperformed or will continue to underperform and add it to something that's been sold down equally and hopefully get a higher bounce. So we should always be doing that with portfolios, but this provides a fairly stark example of, you know, why we might do it, go a little defensive and then use our remaining cash to take up some of the things that will inevitably happen. We're seeing in this market some of the corporate actions, some of the share purchase plans, such as Cochlear that came up at $140, it's trading in the 180. So you don't have to time those ones, the timing's being provided. So I agree with Adam's earlier comments and just add, probably, if you're going to panic early, there's no point panicking now. Get your ducks in a row. Get your ducks in a row, get the portfolio, the wagons in a circle, and make sure it's resilient, and use whatever cash and access we had through dividend flows to add to it on this dip.
And Niv, from your perspective?
Yeah, I think it's important to know or remember that markets are forward-looking. So the prices that we're looking at today represent what the market expects going to happen in 6 or 9 months down the track. So the market is already factoring in weakness. It's already factoring in unemployment at 10%. It's already factoring in jobless claims, etc. But what the governments have done very, very well in terms of central banks and also fiscal policy relative to the GFCs have come in early, right? I mean, during the GFC back in 2007, 2008, central banks and the governments waited at least 12 months before acting. And what we've seen is extraordinary measures. I mean, 15 or 16% of our GDP right now has been spent by the government essentially to stimulate the economy, whether it is for job seekers or employment benefits. Central banks, we've seen, the RBA cut interest rates at 0.25%, unleash a huge amount of quantitative easing, obviously. So that's very, very positive. The other thing as well is talking about placements. What we're seeing right now is that those companies that are going early are actually benefiting significantly. So, John, you mentioned Cochlear was $140 per share. It's currently trading at $189.50. Flight Centre raised $700 million at $7.20. It's trading at $11.56. Webjet raised money recently at $1.70, trading at $2.94. And Nextech just a week ago raised $670 million at $7.80. It's trading at $8.67. So what we're seeing is that those companies are going early are actually benefiting significantly because investors know that their balance sheets are really strong and they can maintain that over the next 6 or 12 months.
And just on that, Ben, capital raisings, what are you seeing from a capital raising perspective? You're watching it daily from the big companies all the way through to the small ones?
Yeah, it's an interesting spread. There's over 2,000 stocks on the ASX. There's a lot that traditionally need money and a lot that traditionally don't. And I think what's interesting is we're seeing the ones that traditionally don't pop up. Like to see Cochlear pop up and raise money for the first time in 25 years is a big move. To Niv's point, yes, they're obviously now in a position where they can ride this wave out. And I think we're sort of seeing the two ends of the spectrum. It's the super strong players coming out who foresee the need to raise money at some point and knowing that there's not an endless pool. Super funds and instos don't have quantitative easing as their own internal tools, unfortunately. So there is only a sort of certain limit. So they're shoring up quick. And then the other people, the Webjet, the Flight Centres, etc., are people who have to do it. Like there's no choice for them. They needed the money, otherwise their business falls away very quickly. And I think there's a huge gap in the middle of people and companies that are going to try and either postpone or wait it out. And that's where I think the real risk comes in for those businesses. And I think it was you, John, who said, if you're going to panic early. And I think that's as true for companies as it is for investors with holdings. So look, our view, we're seeing lots of deal activity at the moment, obviously, a lot of investment bank-led deals. I know there was a Canaccord deal a couple of days ago, maybe yesterday, that was extremely hot, probably, I won't go into the numbers, but multiples over subscribed based on conversations. So there's a lot of demand for these recaps. I think there's a lot of preference to giving these recaps to existing holders as well. So, I think there's another argument to not sell out entirely if you're wanting to reduce positions, because there's either the SPPs or a preference for existing holders. But yeah, it's the tip of the iceberg in terms of capital raises.
John, you touched on before that you act particularly for a number of offshore investors. Are you seeing those investors showing more interest in the ASX, or even more offshore investors coming onto the ASX, given pricing, given valuations, stimulus packages, etc.? Is the ASX seen favourably by offshore investors? And if so, are there particular jurisdictions that are coming to more than others? Or coming?
Good question. Most of the offshore investors I see are Australian expats. There are nearly 1 million Australian passport holders offshore, so there are plenty of people eyeing off Australia. Typically, I think a few of them have thought, well, the market's been overheated. They've been waiting for a fall, and the fall's certainly come. I actually see it's been interesting the last few weeks is that we've all heard of fear of FOMO, fear of missing out. I'm actually seeing a bit of that in terms of some of the clients, particularly in the Gulf and places like that. Maybe that they're sitting, they're under lockdown as well, wanting to get things done, wanting to get into this market, and there's an immediacy and urgency about it. So, as we all know, account opening in Australia is difficult. It's often the storm before the calm. So, getting the accounts opened is for new clients is, they're getting impatient with that. But before the fear of missing out was FOMO, and that was fear of not getting out. And I think we saw that a couple of weeks ago. And that was that day, we're all part of it when the market just crashed and hit its low in the low 4,000s. And, a lot of people with their fingers on the trigger ready to go in thereafter. As I said earlier, whether we've seen the bottom or not, I don't know. We'll find out in a few weeks. But normally we retrace and it forms a new bottom, and it revisits the bottom and maybe breaches it, as I said earlier. But certainly from an offshore perspective, I've been pleasantly surprised by the amount of interest in the Australian market of people who are saying, well, the market's been sold off by 30%. The dollar is at a reasonably low level. Here, have some money and let's get stuck into it.
So maybe, Adam, a question for you. Are you seeing money coming back into the markets, and how laser-like is the focus? Is it just looking at ASX 200, or is it looking sort of down the list a bit further? And is it sector specific? Is it market specific?
Well, I might not be the best one to answer that question, because I'm looking in the blue chips, I'm looking in the top 20, and I'm not really looking out of there, because I just think there's too many opportunities in the top 20 to really look beyond there. So I'm really not, I just think there's just too many opportunities there to spend too much time elsewhere. And you can't do all things either. You can't, well, for me anyway, I can't cover too much ground. So, I pick an area, know the stories well, and then you form that view. So maybe some of the other guys, but clearly there's money going. What has been surprising, just picking up John's comment on the offshore stuff, what has been surprising dipping is just how much cash is there and wanting to be deployed. So, and then what you're finding in the junior end is where there's been some companies that have been hit by the virus just because the whole market's been hit by the virus. Companies are still going strong, management's still going strong, they've got cash, and they're the ones that are getting hit because everyone needs cash, liquidity, and they're providing some very good opportunities. And I guess the only comment I'd make, just for investors to watch in being stock specific or sector specific, is just be careful of the stocks that have run up because of the virus and everyone's getting overexcited about them. And you think, wait a second, guys, when the virus does get solved, whenever that is, really, do you want to be owning a company that's got hand sanitizer? So I think you've got to be aware of the sectors not to be getting overexcited about, as well as the sectors to get excited about.
And Niv, from your perspective, are you seeing money coming back into the market through your clients or companies you're involved in? And if yes, are they focused on any particular areas in the market?
Yeah, I think it's interesting. The Australian dollar's fallen quite significantly against the euro and the US dollars. So if you're an overseas investor and the fact that the market's fallen by 30%, you can pick up some gems, right? We've seen a lot of money being thrown in placements, as Ben said, and as per my point with whether it is Nextech or Oil Search just recently or Cochlear and vice versa. But some of the small caps, absolutely. I think communication is really important. So what we have seen is those companies that have been upfront, and investors know that the outlook statement is going to be impacted, but they've been very, very transparent. As soon as they've been transparent about the COVID and the outlook and that things are tough, but they're cutting salaries and they're doing everything the right way, I think you're seeing a really strong uplift. And look, commodities have picked up, especially gold and uranium in Australian dollar terms. We've seen some money coming back into those COVID-led deals. As I mentioned, AO1 yesterday traded on 57 million shares and was up 300%. The hand sanitizer. So there is, some themes, but it comes down to fundamentals, right? And the market will go back to fundamentals and cash flows and revenues. And I think there's some really, really nice gems at the moment, as Adam said, whether it is in the blue chips or whether it is in the smaller end. So absolutely, we are seeing a bit of inflows coming through on the mid cap and the small end as well.
And Ben, from a placement perspective, you're watching daily what each company is doing from a capital raising perspective. Are there any themes that you're seeing, that any particular sectors where they're coming out and they're getting their placements away?
Yeah, look, I think it's interesting that it's probably the similar number of deals, but they're much higher value. You know, we saw the changes that the ASX put through, was it during the week or last week, with around the 25% change. So any company can now raise 25% as long as they do an SPP or an entitlement offer as well. So that just broadens it, and that was used straight away by Webjet and Flight Centre and others as well. You know, there's a lot of data players, or, you know, players that are taking advantage of the rise in, you know, things like this, right? Like, we're all using more data to connect with each other, and we saw that come through with NextDC, and there's a few smaller players as well. So, you know, I think there's themes to pick up on that aren't necessarily hand sanitizer related, or, you know, test kits coming in related, etc., that have got some more longevity. But on the whole, yeah, I really, my personal view is that this is almost just the start. Like, the long-term economic impact is going to be quite drastic. I think that there's a lot of changes to how we live our life that aren't factoring into markets, from, you know, the amount of takeaway coffees we get to the amount of data we use at home. And that's going to be an interesting thing to play through the market. And it's not going to play through in 6 weeks, and I doubt it'll even play through in 6 months. You know, if we're really going to be living with this thing for a year or two, until a vaccine's around, if that's the play, then there's going to be some massive long-term impacts.
Take your point, and just sort of circling back a little bit to your part of the business. In terms of discounts, are you seeing them more aggressive? Are they more close to market? Are you seeing any differences in this time compared to the last 6 or 12 months?
No, definitely. I saw that Q&A come through as well, so thanks for whoever submitted that. Yeah, look, definitely. You know, we're seeing the large IB deals getting done fully underwritten, which is, you know, 9 times out of 10, they're fully underwritten, which is fantastic, but they are at significant discounts compared to what they used to be. You know, might have been a mid-single digit discount of around 5%, is now 12%. And it's also, you know, off a share price that might have dropped 30% since its peak in Feb 20. We're also seeing at the bottom end, really outside of the 200, the only deals that are getting done at the moment are getting done by existing holders. So it's not necessarily new money coming in a lot of cases. It's people who, you know, were supportive of the stock 6 weeks ago at 20 cents and are supportive now when it's 10 and it's raising at 8 or 9. So we're not seeing a lot of, you know, the recaps that we're seeing from the top. We're not seeing that at the bottom yet. The companies who have the supporter base to raise and keep going are doing it, which is great. The ones that aren't are hibernating. And that's where I think we'll see a lot of those come through. I was talking to a very active professional investor probably 3 weeks ago. And, you know, someone who would have put through $3 million last year bidding into deals through us, and he's just sitting on his hands. He's like, there's a lot more pain to come. And from an investor point of view, you know, he's fully set up, you know, he's watching daily, he's doing all the work, he's, you know, picked off a couple of opportunities so far. But realistically, he's like, there's just a lot more to come through. So I think at the bottom end, we're going to see much stronger discounts and recaps.
John, a question for you. Looking at the right now, but certainly probably the next 3 months, which is very hard to predict at the best of times. The IPO market, what do you think from an IPO perspective? There's clearly companies that have to come to market now for a range of reasons. How tight do you think that market's going to be? And what sort of companies do you think will traverse that market over the next few months?
Well, it's going to be a drought for IPO markets given the uncertainty that's around. I certainly take Ben's point. We just don't know what the next few months are going to bring. So placements we've discussed and those early charges into the market for capital raising. As we all know, and it's always worth restating, the primary purpose of the stock market is to raise capital, and there are a few ways of doing it. One is through the IPO. So, I know of a number of IPOs that have been put off. I think the despair in amongst corporate teams is, how are we going to do that? There'll be placements coming up. I suppose one area that we may see some interest in, depending on what the price does, is the gold sector, and that could be an area of activity. But certainly, I'm not sure what Adam and the rest of the panel think, but it's a difficult one to put an IPO in front of a client, particularly a private client, in this market, given the uncertainty. That it want to be very compelling. So I think a lot of them will have been delayed. I think a few of us have put seed into various companies. We're certainly not expecting to see them in the next 3 months.
Niv, up to you.
Yeah, I mean, similar to John, we've seen a lot of IPOs being pulled. And look, if you're a private company trying to list, you probably won't get any traction over the next 3 to 6 months as a minimum. I mean, we've seen Atomo through Canaccord, and that's an interesting one. That's got the COVID test, and there's an angle there with the diagnostics. But other than that, I think the market will focus on a number of things. It will focus on underwritten rights issues, share purchase plans, placements, and look, venture capital and private equity. I mean, private equity will do well, but venture capital, if you're trying to go into a seed investment right now, I mean, forget it. So look, I just think you have to be very stock specific, sector specific, and play the themes. There's definitely money. There's a lot of money on the streets waiting to find a home. And you've seen that with some of these huge placements through Flight Centre, Webjet, Nextech, Oil Search, $1.1 billion. I mean, where's all the money coming from? There's a lot of money sitting there waiting for the recapitalisation. So I think from an investor's perspective, don't rush. Wait for these companies to do a capital raise or try to get access to it through recap. And your downside risk from my perspective, obviously general advice, is a lot lower once the money's there and you've got a stronger balance sheet and there's a stronger outlook in terms of runway over the next 6 or 12 months.
And Adam?
Well, I'm doing two. So I think the IPO markets, just forget it for the time being. Saying that though, I'm doing 2 private raisings, which would be companies that would normally go to a listing. And this is a good opportunity for anyone who's got cash who's in a good position at the moment. But we'd structure those transactions. One of them, we're going to do a convertible note. That works very well with an interest rate. And then on the other one, because it's only a group of probably 10 or 12 of us as shareholders, we're saying, let's not worry about the valuation. We'll all loan the company money so that, and then once this market sorts itself out, ours are loans, and then we can talk about converting. But if anyone was trying to do an IPO at the moment, there is a lot of money out there looking for opportunities for guys that have got good companies, good management, and the virus has just affected them. And they're out definitely looking for those opportunities. So, but to get an IPO away, no, I wouldn't. I think.
Just, David, if I could just jump in on that private note, like where it's a good point that Adam brings up. And again, you're probably getting that money from the people connected with the business. Is that true in both cases, Adam?
So what we've got is a group of investors, high net worth. They want to see any opportunity. So I get your point, Ben, where you're finding a lot of things. It's the inner sanctum, people who know the deal. No, but there is a very group of high net worth, good businesses, strong cash flow, going, this is just putting lots of opportunities out that they wouldn't get otherwise. They would have to go pay an IPO price. As I said, you feel sorry for them because it's not their fault that the virus has come. But no, this is fresh money looking for fresh opportunities.
Yeah, I think the interesting thing, companies that are already listed, the money's there, it's a question of what do you have to give up? And I think, you know, well-established private businesses, it's kind of the same by the sounds of it as well. Early stage businesses, whether they're listed or unlisted, are going to struggle. So companies that are pre-revenue are going to struggle. Companies that have, you know, haven't got over the hurdle of customer acquisition rates, the like, are going to struggle. From a, you know, we're a fintech startup, you know, for want of a tag, and we were lucky enough or fortunate enough to raise towards the end of last year for our business, but we know a lot of other younger, high growth startups that are just starting to fall over because there's a lot of opportunity out there for people with cash. So, and I think that's where the public market thrives, because the opportunity's there, it's liquid, it's easy to determine value, it's easy to show the change in values, whereas in private land, that's difficult.
We've seen that. Sorry, Ben, that's a really good point. I mean, we've seen the ASX, and we saw that towards the end of last year, make it harder for early stage companies to list to protect the retail investors. So, I mean, those companies that are, as you said, early stage, pre-revenues, trying to raise money on a theme and an idea, I mean, forget it. So that's how the nature of the ASX has changed. And we've seen that going all throughout the 2019 and obviously this year as well. So I think the ASX is doing the right thing by protecting the retail investors. And as you said, there's so much more money for listed companies. I mean, if I'm a high net worth investor, why wouldn't I just try to get stock in Nextec or Cochlear at $140 or CSL or a discount in XTC or Flight Centre or Webjet, then go out and, you know, put money in an unlisted private business that's early stage. So, yeah, I mean, that's the theme at the moment. I think, unfortunately, we're going to be like that for the next 3 to 6 months, but there are definitely opportunities, as I mentioned on the recap side.
You touched, there was a question that's just come through, which sort of relates to me, which is around what should companies be doing at this time? And from our side, running an investor relations business, what we tell our companies is don't stop talking. So we've been doing a lot of broker meetings using this sort of format, and I think brokers are open to receiving meetings in this format and getting briefings. But I think, touching on a point made earlier, it's really important for companies to stay on the communication channel. So they've got to keep talking to brokers and doing the like, because if they fall off the radar, they might be gone forever. But I suppose from a broker perspective, how interested are you in listening to news stories or opening door or taking meetings for news stories? Or do you just sort of stick to your knitting and just focus on the companies that you're already in and you've already got clients in? Adam, maybe for you first.
Well, just to give you a plug, just for your own benefit, I think you're discounting what you're doing, David. So we won't mention stocks, but, you know, David's doing a particular job for a company that, you know, we've got a significant shareholding on. But what David is doing is not just communicating and talking to investors and keeping that. It's the way you're doing the communication, which in this environment has had to change. And so without being stock specific, but what you've been doing for that particular company and how you've communicated it to, you know, small cap instos, family office, to the current shareholders and to industry players, you know, I haven't seen anyone else do the way you're doing it, which is why clearly we've been using you. So, you know, I think in that question, I'll pay you the $20 later. No, but there is stuff you're doing. So when people ask that question, I assume it's a corporate asking why and what they should do. Yes, they should be communicating, but in this market, they've got to be clever how they communicate. Otherwise, it's just wasted. Because otherwise, all of us on the panel here get bombarded with email after email and etc. So answer your question is, we'll always look at new stuff. Always happy to, you know, look at any opportunity. Clearly we know, so for me, I'll know certain things extremely well. So that means I do know, and when we take an investment, we will sort of participate in 3 or 4 or 5 cap raisings for the same client in the low end. So we normally stick to that. So those companies haven't changed in our view with the virus. But, you know, we'll always have a look at new opportunities. And even if we don't participate, we'll always try to at least leave the people showing us within a better position than before they arrived. But you'd be mad not to be looking at opportunities. But they have to be good to get through the opportunities that are out there that anyone on the panel is aware of at the moment.
And John, maybe to you, are you just sticking with what you know and soaking up stock in what you know, or are you open to new ideas?
Oh, no, I think always got to be open to new ideas, and I think you made a good point, Adam, about people got to be smart how they do it. But just an example, I had an example yesterday. I had a phone call from one of the ETF providers, and of course normally they're careful not to ring while the market's trading and all that sort of thing. So we had a chat. He was able to go through a few things that I'd had in the back of my mind, introduce a few of their ETFs that I hadn't really focused on. And I found it very useful indeed. And just a sign of the times, his office is all spread out all over New South Wales. So he's sitting in his parents' property outside Newcastle, 2 acres, you can sort of imagine a shotgun on the front porch and all that sort of thing. But he was making his business calls there, and it was a very useful call. So, it's times like this for all of us. The 2 things that our clients look for are relationship and performance. And this is when the relationship really needs to be strengthened. And our performance, we can't make markets go up and down, but we can be in there actively working for their best interests. So anyone who sort of goes into the fetal position and disappears for a few weeks, it ain't going to work. So keep doing what you're doing, David. And this sort of thing's ideal. I mean, I think it's hopefully for the participants, but certainly for those of us who were part of it, a useful way of exchanging ideas across Australia, really. So thanks.
And Niv, over to you.
Yeah, I think communication is really important. So your initiative, David, in putting this together is fantastic. Companies do need to communicate. I think video is an exceptional way to communicate. And look, guys like us get 400 emails and 300 WhatsApps and SMSs, and we get distracted very easily. So I think it's really important to communicate if you're a corporate and regularly communicate and just be upfront. Everyone knows that things are tough. Everyone knows that the outlook's uncertain. Everyone knows that, that things are going to be difficult over the next 3 to 6 months, but talk about it, get it out and communicate via video. I mean, we had a company, for example, called Spectre that we're large shareholders of. And I mean, Jared did a fantastic job and put a video testimony on him and the business for the next, for 2 to 3 minutes. That's a really nice way. And the ASX, if you're a corporate listening, the ASX is a fantastic marketing platform. It's not a free marketing platform. You're paying your fees, but it is a great marketing platform to showcase what you have. So we do get shown a lot of press releases, but if there's other ways and innovative, whether it is video or interactive, I think it's fantastic. So communication is very important.
And Niv, what about, you've got a number of portfolio companies. Do you just focus on them during these times and just wrap your arms around them? Or do you still keep your eyes open for other deals?
Oh, look, as John said, I mean, we're always looking for other deals. I mean, I was on the phone because I was living in 2 years in Canada. I spent a lot of my time in the morning speaking to the Canadians and getting an understanding of what's happening there from a theme perspective. We're seeing a lot of different companies here as well. So always keeping an eye on things. I mean, we did, we're trying to make sure that our core group of companies survive and thrive and do the right thing and work alongside them, whether it is Digital Wine Group or Lifespider Health or Timeless or Candy Club or some of the other Sweet Earth that's coming to a listing. So we are always working with management. An example, Sweet Earth is listing in Canada in 2 weeks' time. And we're organising an investor call such as this next week. So I think communication is really important, but you can't be complacent. You have to be adaptive. You have to talk to your clients. You have to be on the front foot. You always have to see different ideas, but also obviously ensure that your core portfolio is moving in the right direction.
We've got a few more questions coming through, but before we just jump on those last few, and you don't have to name them, and it's probably for legal reasons good that you don't, but in the ASX to top 20, top 50, do you think there'll be casualties?
Good question. I reckon there may be. Well, so there'll be definitely. Well, there'll be some that will probably pop out of the top 20, and what you got to look at. Some of them is just they're good companies. That's why they're in the top 20. Just looking at what their debt positions are, and can they raise money? There probably won't be casualties, but they might get taken over.
John?
I think Ben's comment earlier about the coronavirus and just where we are, I think there are probably three scenarios going forward, and that will have a major impact on the top 20 companies. Whether any of them fall over, whether they're too big to fail or not, remains to be seen. But I think that, just really quickly, the three scenarios are probably a V, and that's a good example. China moving through it, Korea moving through it, the extraordinary Reserve Bank and budgetary policies that have met this. So we get a flattened curve on the one side and a V-shaped recovery on the other. The next one's probably recession, and a fairly profound recession, and that's more like a U-shaped recovery, and that's going to be tougher for the companies. The next one's actually a depression, and a depression, which we all think of the 1930s, is actually a couple of quarters of double-digit negative growth, and that is a really deep V. That's very possible. And then you get, the perma bears who say it's going to be an L, and we're never going to come out of it. But bears don't earn shares, as I'm fond of saying. So I think the stock market is going to reflect all those scenarios, often on the same day. But I think in terms of companies disappearing, it's a very good question, and the answer is a function of how long the coronavirus continues to disrupt this economy to the extent that it is. I mean, we just got to walk around the streets and see the number of businesses that are holed up, the fact that most of us aren't in our own offices, etc. Certain companies are doing well. Certainly tech companies are doing well out of it. Other companies are going to go broke, and that's going to be reflected in the banking balance sheets, etc. And our banks are too big to fail, so they're not going to fail. But it remains to be seen. We'll know in a few months.
And Niv?
I think the top 20. Sorry, Benny. I think the top 20 will stay safe. I think the point, though, what we are going to see is a lot of consolidation and a lot of merger activity in the space, probably outside the top 20 more specifically. I mean, you're looking at the oil market, for example. Oil's fallen to, at one stage was trading around $20 a barrel. So there'll be a lot of casualties, especially if your cost of production is higher than the actual cap right now. But I do think there's going to be a lot of M&A activity, and companies will have to adapt. Companies will have to change. Companies will have to move. Companies will have to shake. Companies will have to look at different ways to diversify their revenue streams. And that's not only companies. I'm talking about listed companies. It's probably guys like us, right? I mean, guys like us, whether it's David, your business, or Benny, your business, or John, will have to adapt and change. And we can always go under and sit under a rug and feel sorry for ourselves. But I think communication is really important, and potential partnerships, different partnerships are going to be a big, big point. So I think, there might be some companies that will have to be bailed out or too big to fail, such as the airlines, let's say, or maybe the banks. I don't think we'll get to that point. But I think there will be some of the companies in the smaller end, as in sub, 50 million enterprise values, that if they can't raise capital and do it now and leave it too late, they will fall over. So they need to do that ASAP.
Ben, you were about to jump in before?
Yeah, sorry. I was just reminded of a write-up that I was reading through just before this call from I won't say who it was, but it was a doctor who developed one of the first test kits for COVID. And their opinion was that, it's a 2 to 3 year time window until we've got a vaccine that's mass producible and able to be distributed. That their view is that, you're basically going to need passport clearance, like, if you've got antibodies as an example, in order to travel. So, if you take that view, and that's not a economic view, but if you take that view as a restrictive process, then how many travel companies and the like will need help? It only took, like, Webjet and Flight Centre had to go to the market 4 weeks after the crash. Like, it wasn't like they had months of reserves. It was a month. And so, you know, if this thing drags for 6 to 12, I don't want to be the guy on the call who's, you know, predicting the end of the world. I don't think it's going to be an L. But if it does go on for more than 6 months, it's going to be huge impacts to a lot of, like, directly to companies, and then the flow-on effect, whether it's a bank or whether it's bad debts across all sectors, or, you know, and people with thin margins and high debt are going to struggle.
We're seeing, sorry, John.
I was just going to make a point there, because it is about the virus, and understanding the virus is very important. I don't want to be a layperson trying to explain it to people, but, you know, one of the things about stockbroking is we often have some very interesting clients, high-profile medicos, etc. I think that the thing I cling on to is it's a curve. It's not like it stops, and it's a curve. It's not like diphtheria or dysentery or something like that, you know, it's a linear progression. It curves off. There are a few reasons for it being a curve. We don't want it to be the sombrero style curve, a la Boris Johnson's comment. We want to squash the sombrero, but curve it is. And harking back to the dreaded Spanish flu. Spanish flu decimated the world. I mean, it took out a lot of people. You either got it and died, you got it and had immunity, or you didn't get it. But it went away after a couple of years, and it didn't come back, and there was no vaccine. So our hope has got to be that this curve theory, if you like, leads to some kind of herd immunity and the sorts of things that we were just talking about in terms of the ability to travel. We'll find out over the next few months, but in terms of the shape of the recovery and the impact on the economy, you know, look to Italy. If it's true that the Italians are going to go back to work in the next few weeks and the Ferrari factory is going to reopen, you know, watch that as an indicator. That's very interesting. Very interesting that Shanghai and China, in China and Beijing in China, haven't been hit the same way Wuhan was. Obviously, New York City's getting hit, but if it's a curve, it peaks and continues. So we've all got to get our heads around something that's quite difficult, quite foreign for us. We don't want to be the faux medical expert, but a deep understanding of this virus and the impact and what the curve looks like is important to understand, and understanding how long the economic effects are. And of course, the stock market's going to rotate between the various views, some of which have been expressed in the last 10, 15 minutes. So I don't know if anyone else has got any comments on it, but I do cling to the curve theory as providing some hope to some kind of uptick on the other side of the valley.
Well, I think, John, just on a comment, if you go back to the GFC, which was sort of came out from subprime and then hit the consumer market. This is the consumer market going back to the credit market. But one thing about human nature is we'll all work out a way through it. So, from anyone on the panel of investors is trying to work out where those managing risk and where those opportunities are, because we will get through it.
Well put.
So one final question off the Q&A slides, and it really relates to the ASX, and I don't want to get anyone in trouble on this comment. We've seen state government stimulus, we've seen federal stimulus. Is there things the ASX can do, and I'm not suggesting this should do, but are there things the ASX could do to help the market more and help the broad market get through this?
Well, I don't answer. I think they're doing a good job. They're adapting as the times are changing, which is why they've come out with different policies and practice notes. So, at the moment, I think they're doing a pretty good job. I'm assuming they're watching it, so I'm just saying that. But no, I think they are adapting to the environment as we are, and I think they are being proactive on it.
Niv, you have a view?
No strong comment. I mean, I think the ASX, as Adam said, are doing a good job. I mean, the real question is similar whether it's the Australian, Football League or the NRL. Will there be any bailouts by the ASX? I mean, that's an interesting question. But overall, I think they're doing a good job.
I might just throw something in. It's interesting because on Monday morning, I sort of reached for my phone at some ungodly hour before, it's still dark. and saw that the head of, well, it wasn't Monday, it was later in the week, head of APRA said, you know, the banks should consider deferring or reducing their dividend payments. The Commonwealth Bank had already said that week they've been looking at its dividend levels, and it was comfortable with being able to get through the next months and years. And I felt that APRA comment, that's the sort of comment APRA are almost obliged to make, because they're about the, you know, the prudential regulation of the financial sector. But we have the best capitalised banks on the planet, as far as I'm aware, and effectively telling ASX shareholders that they can kiss their interim dividends goodbye. This is for pensioners and people like that. I found needed a response, and in the myriad reports that were on that day, from Cardinal Pell to Boris Johnson having coronavirus, I'd like to have seen some kind of response. Now, arguably, it shouldn't be from the ASX. It should be from the banks themselves looking after their shareholders. But I did think that understandable commentary from the Prudential Authority should have been challenged more by the market and within the market.
And Ben, you're dealing with companies daily in terms of raising capital. Is there anything, you know, the ASX have made some pretty substantial changes in recent times to enable that process to happen easier. Is there anything else that you can think of or are hearing that companies need to help them survive?
No, I think they've been very quick to react with the 25% change to the placement component. But also, you know, I think they've done well to make sure that, you know, there's provisions in there for retail holders too, or for non-institutions, right? So you look at NextDC when they raised, I think it was NextDC, they've got an uncapped amount to be raised through the share purchase plan. So, you know, any existing holder can get their 30 grand in that stock at what is now a very good price. And whilst the directors have got discretion over that, it's technically uncapped. Don't hold me on it if it is that stock. It's one of the top ones that have raised in the last week. But you know, I think that's a great provision to put in there for, you know, the strength of the broader market, not just you know, not just the instos as well.
I think sorry, David, what the companies are doing well, right, and I'll credit to management and to the ASX combined, is trying to reward the existing investors. So, you know, if you're, as Benny said, NextDC or a Santos or an Oil Search or a Webjet or a Cochlear, allowing the existing investors, whether it's through rights issues or the share purchase plan, at discounted rates, it's very, very attractive. So I think they're doing that very, very well. I think the 25% placement capacity is excellent. And as I said before, and I keep coming to that point, those companies that need capital need to do it quickly, and they do it now, because what you find is as soon as the balance sheets are restored, normally those stocks go up, and they go up very, very quickly. So coming in on the recapitalizations of those companies, whether it is in the big end or smaller end, is a great way that we feel that you can generate some good alpha for your portfolio.
And we're just coming up on the hour, which tells me there was lots of questions and a lot of good discussion. So maybe a bit of a around the grounds, given we're spread out all over Australia on this call. Now, I'm going to ask you to answer the question, but note that it is not advice. It's more an answer to a question. Maybe starting, Ben, with you. What should an investor out there be thinking, looking, doing in this current market? And I know I preface all of this with it's not advice, and everyone will have their own unique financial situation. But you know, as what would you be thinking, maybe even in a personal capacity?
Yeah. So our advice is purely to be prepared, right? So make sure whatever your decision is, make that call and get ready. I think, you know, get cash ready, be looking for opportunities, and, you know, speak to your broker, get set up with regard to making sure that, you know, maybe they're aware what stocks you're interested in, or so that, you know, you can move on market quickly if there's an opportunity. Obviously, you know, get ready for placements. We know deals are coming through. Like, as I said, this is just the tip of the iceberg. After the GFC, I think IPOs dropped from $22 billion to $2 billion, and secondary raising, so placements and rights, went from 50 to 80. So, you know, more money was raised post GFC than pre. It was just in a different capacity. So just, you know, preparation is key.
Adam?
Well, and obviously this panel is talking about financial and money, so taking away the human damages being done by the virus. But I think picking up Ben's comment, I think this is an opportunity you're going to get once every blue moon. So there's lots of windows. Maybe don't listen to too much noise, because there's a lot of noise that's just not relevant to an investment decision. But I think picking up Ben's comment, it's about managing your risk and picking the opportunities. So, you know, make sure you seek the right advice. But as I always say, we fast forward a certain time period, just exactly like when the GFC was occurring. You know, everyone during that time was, you know, the world was going to end and all that stuff. And you know what? Didn't end. This will be the same. So I think for investors, make sure you're getting the right advice, but there is good opportunity, but do your homework. Don't just jump because you read something on some newsletter or, I don't know, it's just lots of that happening at the moment. You think, you know, people say, oh, what about this? And you go, where did you hear that from? And it's because they heard it off somewhere. So just do your homework properly. There's heaps of opportunities around.
Niv?
Yeah, no, I echo Adam's point. I think there are a lot of opportunities. I think the trading mentality has changed. I mean, the time periods in terms of are you a long-term or short-term holder, I mean, is something to be debated. But look, you have to play the trend. Stock-specific, sector-specific, as Adam and John highlighted, really good management with strong balance sheets, come on the recapitalisations, and, you know, you'll do very, very well out of it. I think, as I said before, the markets are forward-looking. So today's stock prices are reflective of what happened, you know, or what the market believes is going to happen in 9 or 12 months down the track. Yeah, back your judgment, and there's some great opportunities coming through, and happy to chat offline with anyone that wants to chat.
John?
I think, look, I agree with everything there. I think one of the themes this afternoon has been the opportunities, if you like, through capital raisings, which, as we said, are at great discounts, and in companies that you know, have good management and are going to be there at the other end. It's a very uncertain time. I think for most people, most of us are over-invested in the market at any one stage. Very few people, you know, sold 50% of their portfolio a few months ago, ready for the downturn. So I think it's a case of existing portfolio holders hold their very good positions, sell off some of the ones that are marginal at best, and bolster some of those better positions, but look for some of the opportunities and some of the themes that have been alluded to today, and use the limited cash and dividend flow to really add to some of those positions and pick up a few new themes as well. But I'd probably just finish by saying, what do we do as people? You know, I'm not a great fan of the ABC, but they did interview someone who got off a plane, and these were the first people who were going straight into 2 weeks of isolation. And they said, well, what do you think? And this guy sort of said, well, 3 things. They said, stay positive, take responsibility for your own actions, and the third one was batten down the hatches, and I think we've been doing that. So that defensiveness, but also looking for the opportunities as well in this current uncertainty. As Adam mentioned earlier, it's a once in a blue moon opportunity to pick up some of these things, and, you know, CSL in the 200s, that sort of thing. Wesfarmers in the low 30s or early 20s, Telstra with a 2 in front of it, Commonwealth in the 50s, those sorts of blue chips, some selected mid caps, some small caps, some of the private equity and corporate raisings that some of us are doing are really heavily discounted. We do our homework, you know, it helps come out the other side. That's what happened last time. I mean, people did better because they were forced, instead of trying to pick the bottom, they took up a Cochlear plan, or they took up a Wesfarmers plan, or they took up a placement somewhere, and it was through this whole process, and in the end probably came out better or more quickly than they would have if they just left everything alone.
On that note, John, thank you very much, and I'd like to thank each of our presenters. So Niv from Peak, Adam from Canaccord, John from Hartley's, Ben from Fresh Equities. Thanks very much for your insights and your time. And for our attendees, thanks for participating and firing through the questions. I hope you all learned something from today's session. We will be doing these regularly, and the opportunity to engage with advisors of the calibre of the people you've listened to today, I think is an exceptional opportunity. And I'd like to thank all of you for participating. We have recorded today's session, and subject to any editing minor bits out of it, we'll share that with each of the attendees as well. But thank you all for attending, and to our panellists, thank you very much.
Thanks very much, David.
Thanks, everyone.
Thanks, guys. Thanks for having us.